So let's dive into Market Matters here on July 9th. As always, if you have any questions along the way, feel free to drop those in the chat function, and I'll try to grab those and address as we go along. So let's get started. Here's just a quick summary of what we'll be covering today. So we've got a few macro topics that we'll be touching on, some of which I've never really touched on before. So I think there's some, maybe some new content in there that you might find useful or valuable. We'll touch on our portfolio themes, how those are evolving as asset class ratings, and then some thoughts around stocks, bonds, and alternative categories with these kind of highlights here. So let's take a look at what's happening within the macro picture, and just have a little picture of a volcano in the background because it's hot as all get out here in Atlanta. So hopefully wherever you all are, it's a bit cooler and not in the heat dome, as they call it. So first things first, the biggest picture, if you will. This is a picture for those that have been tuning in. The U.S. economy broken out in the services sector, that's the purple line, and the orange sector, which is the orange line, which is the manufacturing sector. Interestingly, that they're both kind of registering a reading that's almost identical. That's probably a bit unusual. And recall that this is a consensus survey. So any number below 50 indicates contraction. Any number above 50 indicates expansion. And what you'll note, of course, is that over the last couple of months, the economy does appear that it started to tip into a very, very slight contraction. That's not unusual. It does happen as inventory is burned off or for other reasons. We have other indicators that would suggest the economy is actually doing just fine, but according to this survey, economic activity has slowed a little bit, and something that I would say isn't terribly unusual for the summer months. So we're considering this still pretty much a benign or a neutral environment from an economic standpoint. The inflation picture, I think it's useful to keep monitoring this because this is as you might know, this is our key variable that we've been looking at ever since the start of really 2021, where we thought there was a risk to inflation overshooting to the high side, which did, of course, happen. And there are three readings of inflation here in front of you. One is the producer price index. That's the inflation that producers are experiencing on a year-over-year basis. And that's in the blue line. The orange line is the core inflation rate. That's the line that indicates inflation minus food and energy. And the purple line is the all-encompassing inflation rate, which does include food and energy. And I think what we should note here is that these are obviously going to be very carefully watched by the Federal Reserve. They've been wanting to cut rates here for some time, and I think giving them the top cover to do so would be a consistent decline in the orange line and the purple line over time. And certainly the orange line, the core inflation rate, has been trending lower, and that's been nice to see. The purple line, however, the headline rate, which includes food and energy, has been pretty consistent around this level since about the middle of last year. And I think that does just raise some concerns that we're in a period now of what they call sticky inflation, which means that despite some of the puts and takes that are occurring maybe in housing or in auto insurance, other areas, there does seem to be a number of offsets at play, and keeping the inflation rate above 3%, it's going to make it a bit tricky for the Fed to cut rates. And I would say if they do talk about cutting rates, that would give us a little bit of concern, because then historical examples would indicate that if they do that while inflation's still running at 3% and steady, that they run the risk of stoking inflation further, which is probably one of the risks I think we'll come on to for 2025, not necessarily for 24, but more for 25. Just some broader, bigger picture macro gauges of the economy. You can see air travel. This is, I thought, an interesting chart from Macrobound showing U.S. air travel TSA checkpoint numbers over the last number of years. And of course, what you'll notice is, despite the fact that airline tickets are rising in price, the pent-up demand still continues to be working off, and more people going through the airport system. It would indicate still a level of discretionary income that's consistent with a growing economy, and that we have I would say, a pretty solid underpinning for our broader macro conditions. The big one that I haven't really talked about before, which I think this chart does a great job of explaining, the impact of AI to some degree, is this chart right here, and it's corporate capex. So we all know that the U.S. consumer or the U.S. economy is driven by primarily the U.S. consumer. It's roughly 70% consumer oriented, 30% industrial and company oriented. But I think this chart does a good job of explaining why the AI theme has been and will be likely for the foreseeable future so impactful to stock prices, not only in certain areas, but also the broader market as a whole. And you can see, whereas, 10 years ago, 2014, CapEx coming out of the largest, what they call hyperscalers, so that's Google, Amazon, Apple, Microsoft, Oracle, and Facebook/Meta, was only $21 billion a year. Corporate CapEx now on things like data centers, chipsets, things that are going to make AI more feasible in the future is now ramping to a pretty sizable amount of $181 billion a year and rising. So all the indications from these companies as well are that in the future, CapEx spend will be higher than it is today. And I was telling the team, on Monday, we have a weekly team meeting, and there's some concern, that this is starting to look a little bit like 2000. And certainly, while the ramp up in spending is similar to that period of time, I think what's really different this time is, and those are obviously dangerous words, so I recognize that as I'm saying them, but what's really different this time is that the CapEx spend, or the capital being spent in the 90s, late 90s, was debt financed, meaning that companies like MCI, WorldCom, Pets.com, JDS, Uniphase were taking on massive amounts of debt to spend on the build out of fiber optic lines and things of that nature, optical cables. Whereas this time around, all of this capital is actually coming out of company earnings. All these companies here have had a very low and modest rate of corporate debt. They are not ramping up corporate debt at all. And I think, this is a big reason why we think this AI build out, while it's occurring very rapidly, is not as much of a concern as maybe it would be back in the 90s when it was debt financed, because of course, any rise in rates as they did in the 90s into 2000, 2001, where 10-year bonds were around 5 to 5.5%, I think. With rising rates, that was pinching balance sheets and income statements as net interest expense was rising. In this case, this is all coming out of cash flow and earnings. So we think this is still a very big secular tailwind to the markets that lead us to believe that while valuations are a little bit potentially in the higher end of normal, that this level of spending is actually not normal, and therefore margins can be probably a little bit higher in the future. But we'll talk about that in just a moment. So that's kind of a big tailwind. We just wanted to point this out because we've been talking about this for some time. Will Biden leave the race or not? Is a big question mark right now, particularly after some very hit or miss appearances, not only in the presidential debate, but also on George Stephanopoulos' show. And this is the betting markets. And this is as of 7/3. I would say this has changed a little bit now. The odds of Harris and Biden, moving into the future are about equal. This is who is going to win the 2024 presidential race, with Trump clearly having a very sizable lead amongst betting markets. Now, this is not necessarily polls that people are taking. These are betting averages where people are actually making bets on one way or the other. And I think just this dynamic between Biden and Harris is going to create a lot of fireworks potentially, particularly in the coming weeks as Democratic delegations finalize their superdelegates. So we'll have to see, and obviously the ramifications of one versus the other, I think, would have some impact in the future. We just don't know what those are going to be, and we'll have to sit back and see how it all evolves, and how either party is going to act as coming into office, Trump versus Biden or Harris. I think it's still too early to tell, to rely on what they're putting forth as far as in debate sessions and policies, because those can change on a dime, particularly as we approach November. So better to be patient and kind of ignore it for the time being. So here, we did update these a little bit. So it does look similar, but I think there have been some updates that we're attributing here to the second half of 24. Certainly some, troubling things going on under the surface to some degree. We still have issues in commercial real estate and by extension, certain parts of the banking system, like regional banks. However, earnings and corporate capex, I think, are big positive offsets that put us a little bit on the razor's edge because yes, we do have known issues, and those are still, I think, working their way through the system. This commercial real estate situation is going to take a number of quarters, if not years, to clear up and get to the bottom of at some point. However, on the other side of that, very positive things are happening in the tech sector relating to AI and other places, healthcare as well, where CapEx corporates are spending money. Earnings are still very positive and surprising to the upside. So that provides a pretty nice foundation to invest around. And I think the point here is that, market indicators are not reflecting a lot of economic stress. You can look at fixed income markets, high yield markets, volatility markets. They're all showing a little bit of the second thing here, which is a benign outlook, but also potentially a little bit of complacency. So we do want to be mindful that, some of these forward-looking indicators of future volatility are not necessarily reflecting a lot of issues in the future. And in that way, we want to be pretty judicious about making changes when necessary, even though things aren't moving around a whole lot, and adjusting, modestly as we see opportunities. So one of the things we could be doing in the not too distant future would be swapping out some positions in the fixed income portfolio to be a little bit more durable in the case that we get a lot of rate volatility. On the equity side, as some of you all know, we've been making some changes around the edges relating to, trimming back positions that have run pretty nicely, finding new opportunities in the same sector in some cases, or even more in value-oriented sectors. But those are about the major things we're doing at the moment on that front. Just as a reminder, politics does not necessarily lead to financial outcomes. So we need to be very careful about extrapolating who's going to win and what election. Like, for example, I've seen a lot of press releases more recently in the wake of the UK election. I think the Labour Party won a pretty sizable landslide victory. And there's all this doom and gloom being published about the UK. But I think a lot of it's, of course, hyperbole, because whether that or not they'll be able to get stuff passed in the parliament there, it remains a big question mark. Then, of course, the big elephant in the room is, what will the Fed do over the next 6 months? We're in the second half of the year. Our base case remains they'll be lucky to get out, one cut. And I think two would be a bit of a stretch. But, again, we don't want to put too much emphasis on what the Fed will do, because at some point they will. And they've shown a very high likelihood of wanting to cut at some point. So whether it's, in the next 3 to 6 months, or it's in the next 6 to 9 months, it's almost immaterial, because once they start cutting, then it's very unlikely that they will stop because there's obviously reasons why they would be doing that. And in a interest rate cutting environment, as we showed last time, stocks tend to perform pretty well in that environment. Question mark, of course, I think still remains around what will fixed income do, even if the Fed cuts rates, because we do have quite a big supply issue with US debt. And we want to make sure that we're not overexposing ourselves to any risks that we don't have to. The only, I would say, change we made here, or just a modest adjustment, is putting back to neutral the mid cap that we slightly overweighted in positioning size. Just because of what's happening within equity markets and earnings forecasts. And it's very clear coming into the middle of the year that US large cap, specifically like the Russell 1000 index, has got a much better growth potential to it than either small or mid cap indexes do at the moment. That does, again, whiff of a little bit of a slowdown, because small and mid cap companies are, I would say, more sensitive to changes in economic growth. So maybe that's telling us something. But for the time being, we're trying to invest, of course, for long-term returns, and long-term returns are being found in companies that are growing their earnings the fastest, and therefore having a, I would say, a more preferential bias to US large cap, particularly on the growth side, makes a lot of sense of this venture. Like I said last time, China still remains a wild card. They continue to find banks that pop out of nowhere that have issues. property market continues to be in a state of, I would say, radical change, although it's not changing in price-wise. Many metrics are evolving and degrading to some degree. So this continues to be a slow-moving train wreck in China, which I do think is influencing some other neighbors in the region. But we still have, very little exposure, if not zero, to emerging markets. And our only exposure to international companies is through primarily developed markets. Think Japan, Australia, and continental Europe. Bond market, certainly we recognize that as short-term interest rates have risen, that's given us an opportunity to invest for income again. So that's something that we are certainly, very oriented toward. Our bond duration is, of course, very short relative to the index. However, we still don't see much reason to step into things like junk bonds or emerging market debt, because history just tells us when there's complacency and things finally break loose a little bit, that these segments of the fixed income market, primarily junk, preferred stock, emerging markets, tend to get hit the hardest. Now, when they get hit, of course, that's when we will be looking to make potential adds. And we kind of missed our last opportunity during COVID because the Fed stepped in to buy corporate bonds in a historic move. But we'll be looking for opportunities to buy at much better yields down the road. And then finally, in this environment, I would say alternative assets on the liquid side, non-liquid side have done pretty well. Private real estate, of course, being the one I would say carve out to that, or exception to that, where projects that have been put in place within the last 5 years are all kind of in a stasis moment. New projects or new strategies on the private real estate side coming out actually are showing and reflecting much better levels of return opportunities. So certainly something to consider. But we still have preference to things like private credit, long-short equity strategies, even real asset strategies like infrastructure. Those are all areas of our focus right now. Let's just do a quick review of where we are right now. This is a year-to-date picture through July 5th. So a couple of days on the other side of the end of the quarter, but close enough. And you can see what I was just referring to. Markets are grinding higher. This is kind of the pain trade right now for a lot of people that are underinvested. But it is fairly concentrated in certain areas. Certainly, U.S. stock market is attracting the most capital at the moment because of the best growth profile that our companies have versus everywhere else. So 15% roughly for the S&P through the first half of the year. NASDAQ doing a little bit better than that because there's a higher exposure there. And then whether it's international developed markets, emerging markets, or the Dow Jones Industrial Average, they're all kind of coalescing around this 4 to 5% return, which is, of course, miles away from the 15 that the S&P has put up. And that's because of the lower concentration to technology. So differentiation is good, particularly if you can be more exposed to the things that are working and less exposed to the things that are not. We certainly are at the moment. So our positioning is likely not going to change for the foreseeable future. Now, we do want to mention, of course, valuations are a bit of a headwind for the S&P. So you can see it's a great chart put out by JP Morgan in their Guide to the Market series. Is the forward PE ratio of the S&P. And you can see how it relates to previous periods. Of course, the 30-year average for this index in a forward-looking basis is around 16, call it 17 times earnings. We're currently trading at the end of June at 21. And, that has historically represented, tricky periods for the market, or at least periods where there would be flattish returns. And I think that's kind of what we're suggesting here, is that, and there are a number of different measures that also suggest flattish returns from here. Certainly, we've been saying, we were saying high single-digit returns for 2024. We've obviously been wrong on that because we've overshot that estimate by a pretty decent amount. But we importantly haven't been underinvested. So our thought here is that, yes, we have some headline risk or valuation risk at the moment, but that will be offset by other things, which we'll show you here in just a second. Concentration risk is another, I think, risk for the markets that we certainly don't want to eschew. So, and I thought this was a really interesting way of reflecting concentration risk. And this is the market cap of NVIDIA, which is one of the top 3 largest companies now. I think it's over $3 trillion in value now. That's that gray line, seeing how that's evolved since 2014 as it relates to the total stock market capitalization of the United Kingdom or Germany or France. And what this chart shows is that NVIDIA is bigger than all of those stock markets in every since for the last, call it a couple of months, which is remarkable. But it just goes to show you that, if you have a product that not anybody else makes, that you can have significant pricing power for it, that the market will reflect that as far as valuations. And NVIDIA in particular, I know some people have some issue with that. We still own it in our equity strategies as a core holding. And if you look at the valuation there, actually valuation for NVIDIA isn't nearly as bad as one might think, because earnings have been growing commensurate with the rise in the stock price. It's not necessarily overshot. So you're talking about a forward earnings multiple on NVIDIA of high 20s, low 30s. That was what basically Amazon had for the whole 2020s or 2010s decade. And so we think, for a variety of reasons, it's not as troubling as it might seem. But certainly, if anything negative were to happen to NVIDIA, it just tells you that there would be a outsized reaction in the U.S. market. So this is, I think, a great chart to reflect why we don't have and why we downgraded mid-cap more recently. This just shows you the percentage of unprofitable companies by size over previous crisis periods. And what you can see is currently small cap index, and less so about mid cap, but small cap index has roughly 42% of the companies in the small cap index make zero profits. We got to ask ourselves, why is that? Well, I think two things. One is that a lot of companies came public in 2020, 2021 during the SPAC craze that were all highly unprofitable companies. The other reason is that private equity has taken out a lot of good candidates, and I think there's been a lot of M&A activity to boot from the large cap sector as well. So what you're left with in the small cap segment are a whole slew of companies that are pretty speculative in nature, much more so than they were in previous periods, maybe like in the 70s and 80s, when small cap factor investing was a big thing to do. And this is just hard to step into small cap, especially at the index passive level, when 42% of those companies are non-profitable. Contrast that with large cap, only 10%. This is what we were saying earlier. The earnings growth profile for large cap segment right now has just gotten so much better than prior periods, and one reason why we're much less concerned about where the valuations are trading right now, because earnings are growing commensurate. Now, those were some of the negatives that as headwinds to the market. On the plus side, I think there's quite a bit more offsets, and this is just more equity related, so you have to bear with me here. But what this shows you here is M&A activity announced by listed companies has been increasing for the better part of the last, call it 18 months. And M&A activity as a way of raising valuations, when there's the typical buyout premium when a deal is announced on M&A is somewhere between 20 to 30%. That does have a way of lifting valuations, but this is real money that corporates are spending for business expansion, efficiency purposes, that we think just helps undergird some of the valuations that are in the market at the moment. Because if companies can earn more, they can grow into a better valuation over time. The other thing is that there's a supply shortage of stocks. It's kind of a weird way to think about it, but I just thought this was a useful thing to reflect here. This is the Wilshire 5000 going back to 1975, and you can see back in 1975, there in the Wilshire 5000, there were roughly 5,000 companies. There's a period of M&A in the late 70s into the early 80s that took that number down to 4,000. During the 80s and 90s, a number of companies came public. So the Wilshire 5000 had at its peak roughly 7,500 companies. And then since 2000, whether through M&A or going out of business or business combinations, that number has now been holding pretty steady and declining slightly over time, down to about 3,500. So the total number of companies over time has been shrinking, and I think that just helps underscore why some of the bigger companies have gotten bigger. It's just because there are fewer options to invest in at the stock level. And one reason why private equity has, I think, gotten more important to portfolios, because the number of companies available outside of public markets has been rising. I did show this last time, but just a useful reminder, we are in an election year. The average return of the stock market in an election year, if it's a positive year, is 17.1%. At the end of this quarter, we were at 15.5, so we're almost there. Average of a negative year was 16, but if you remove the outlier years of the financial crisis, you're looking more, like 9. So our whole thought coming into this year was, we've got a skew to the upside because it is potentially, reflecting some election positivity. And that's certainly what we've got so far. So election years tend to be positive on average. And then to the valuation question, obviously, valuation is a relative metric. And so, on historical averages, you have to look at what people were paying back in the old days versus what they're paying today. And this is why you have to just be paying attention to this stuff because, like I showed you on the JP Morgan slide, the 30-year average forward-looking valuation for the PE ratio for the S&P was 17 times. So if you just take, this time series here, this is the profit margin for the S&P, by the way. So if you take the profit margin here and you add it all up, on average, this margin was probably, midway point here, probably between 7 and 8% on average from 1990 to, let's call it 2020. But what you notice is, what's been happening is that the margin profile of the S&P 500 has been improving that whole time. No surprise, over the last 30 years, the forward valuation for the P multiple for the S&P has been bumping up over time as well too. So if the companies that we're investing in are earning more profit on average than they were in the past, then that theoretically should lead to a slightly higher valuation in the future. So this is the net profit margin. You also see this playing out as a free cash flow margin. So how much are companies earning in free cash flow as a percent of their sales? And what you can see is over time, the free cash flow as a percent of sales has been rising almost the entire time. It's not been, a linear move, but my linear regression here does capture it. It's been a bit of a bumpy road, but over time, companies have found a way to be more profitable and generate more cash over time. So the thought here is that there are justifiable reasons why a 21 times forward earnings, while relative to history might seem a little rich, but if you relate it to now what companies are earning as it relates to profit and cash flow, I think it makes a little more sense and less scary that PE ratio is a bit higher than where it has been on average. I guess maybe to net it out, we're not necessarily too concerned with where markets are trading at the moment, particularly in the S&P and the US side. Lots of positive offsets to some of the headwinds that we shared. And, frankly, we're not making a whole lot of changes other than reducing that mid-cap exposure down a little bit, making some tweaks around the edges on the sector side to reflect maybe a better risk reward. The bond side, however, I think is kind of playing out as we were expecting so far. There's been a lot of volatility in the bond market because the Fed and others are creating this volatility. But what you can see is a few things here. You've got the purple line, which is our benchmark. This is the core aggregate bond index total return. Through June, it's down 71 basis points, so another negative year of returns for bonds. Muni bonds are down 50 basis points, so nothing serious or huge, but worth noting. The high yield bond index and EM bond indexes are the only two positive ones here on the screen at 2.2 and 1.4. Again, this is less about price appreciation and more about the higher yield these are paying. But again, our thought here is that if things go a break loose and diverge from some event risk or shock risk, these are going to be down like they generally are, substantially, much more so than the core indexes are. And then I think what really has been not a surprise to us, and one reason why we have no long duration bond exposure in our portfolio is this pink line here, which is the 20+ year treasury bond, which is down in total return percentage terms, 5.6% through June. We could see that being down a lot more as supply issues become more front and center as we get closer and through the election period. So our thought is, why even take the risk? The 30-year bond isn't really yielding that much more than even a 2-year bond at the moment, or actually it's yielding less than a 2-year, not much more than a 5-year bond. Why not just hang out in a 3 to 5 year bond earning the same level of income without taking a lot of price risk. And that's kind of how we're positioned. It is important to note too, going back to the more risky side of bonds, this would apply to high yield and loans, that the default cycle has started. It's not, but it's been manageable so far by markets. It's not been too much of a concern, but things like leveraged loans or high yield bonds, you can see ever since the Fed started raising rates in the middle of 2022, have been on an uptick in default rates. Now, this isn't catastrophic by any means. This isn't a ring the bell moment, but it does kind of tell you where we are potentially in the cycle, and we are a lot closer to maybe a peak in the default cycle than we are a trough. And so, until in which time we reach that peak, we're not going to be too attracted to things like high yield bonds or leveraged loans. We'd much rather take our kind of risk budget within the equity sleeve or even in private markets. And then just wanted to point out, as one of our advisors was pointing out this past Monday, we now find ourselves in the longest period of a inverted yield curve that the U.S. has ever seen in history. So the inverted yield curve looks just like this. And what it means is shorter term bonds are yielding more than long-term bonds. And it's a very maybe unusual situation because generally the further out your maturity date, the more risk you are taking on theoretically. But what this is telling you is that there's something in the system and the plumbing of the financial and bond world that is not necessarily making a lot of sense. And what's not making a lot of sense right now is that we've got an inflation problem right now. That's why the yield curve is up here. That will, over time, over this time period, become much less of an issue, which will allow bonds to yield less in the future. So and at which point we reach the peaking of inflation and the inflation monster is behind us, this will likely be the case. So this is why I was saying, we're paying very careful attention to what the Fed is doing and what they're saying. You can't pay too much attention to it, but just worth noting, because once that rate cut cycle starts to come into play, then we're going to be keen to see how the front end of the yield curve adjusts to the rate cutting cycle. Because what should happen is, as the Fed cuts rates, everything from 1 month to 3 months should reflect immediately downward the cut in the Fed funds rate. So, and you can see where we ended the quarter here with the yield curve: 30-year bonds yielding 4.4, 10-year bond yielding 4.25, 5-year at 4.25. So very kind of flat, if not normal looking yield curve, 5 years and out. It's just this 5 years and in period is looking quite unusual at the moment. I just wanted to point out, there has been a lot of hype, or not hype, but a lot of discussion around what's going on with Bitcoin. For those that, have been following us for a while, you would know that this is an asset we've had some preferential views on for quite some time. For those that took our advice many years ago, you've made quite a bit of money, of course, if you bought Bitcoin back in that time frame. And I just wanted to talk about a concept that maybe isn't too known to everybody, but it's called the Bitcoin halving. So one feature of the Bitcoin asset class is that every call it 3 to 4 years, the rewards that are paid to miners, which is the supply of Bitcoin, gets cut in half. What that has the effect of doing is, if you cut your supply in half, but there's still consistent demand, that's when price really ramps. And what has happened in the last 3 Bitcoin halving cycles is that as the halving cycle starts to occur, which happened just earlier this year in April, you get kind of a lagged effect of that halving cycle, and then kind of an exponential move to a higher price point, reflecting the fact that supply is now half what it was. There are potentially more buyers out there looking for access to this asset class. And who are those new buyers? Well, it's with the ETFs. Now it's individuals that didn't want to open, Coinbase accounts or things like that. But also now, more increasingly, it's institutional investors, think like pension funds, endowments, that are starting to dip their toe into the water to Bitcoin. So could it be that we find ourselves at 100,000 by the end of the year? That's certainly possible. I don't want to make any price predictions, but I think the bias post a Bitcoin halving would lead to potentially upside from here, considering we just had a pretty nasty downturn in 2022. So in summary, not a lot changing on this here. We've still got kind of a sleepy summer in front of us, with a lot of big events behind us, at least on the economic front. The next thing to look at would be, I think, election activity, and that's, kind of hit or miss to see where that's going to lead. But I mean, from here, given that average election year returns are in the 17s range, certainly we could see the S&P, push up to that level over the course of the remainder of the year. But I think our base case still remains kind of a churning market, kind of violently up and down, but not really going anywhere. It is a great time to be managing risk. Certainly with the appreciation of stock portfolios, now is a great time to be trimming back some risk. So trimming back that number, maybe to your target weighting, adding to areas that maybe have low correlation to the equity markets. I think alternatives or even short-term bonds. Certainly prioritizing bonds for liquidity and then income. So we certainly want to make sure that the positions that we have are liquid and not moving around too much in price, but generating a decent yield. And that's exactly how we're structured at the moment. And then, alternatives still make a very nice diversification for the current market setup. By and large, those have done pretty well. Our liquid alternative sleeve has done just fine, performing right in between stocks and bonds, exactly as you would want them to do. Private market positions, maybe a little more mixed results there, but certainly providing that diversification, which is at the core of those strategies. So I think that's all we had for today. I haven't seen any questions in the queue, but I can certainly pause here and see if there are any out there. While I'm doing that, I did have an appendix slide if there's no questions here. I have heard people talk about, the labor market is starting to, show a higher number of jobless claims. Is that concerning? And this is, just stuff that I hear from clients or even some of our advisors. So I figured I'd just touch on it. I think the labor market is still trying to recover from the COVID fallout that occurred, where there was a significant amount of older workers that left the workforce, and just still trying to build back that workforce to a full contingent or complement. The labor market is something to keep an eye on, but it's certainly not something I think that is super meaningful because it moves so slowly. And in fact, with the advent of AI and the application of that AI in businesses in the future, I think the labor market statistics are going to be much less reliable as an indicator of whether, a recession is coming and things of that nature that, historically you could tell by things like credit cards or jobless claims spiking that there might be a recession on the horizon as corporates cut back. But that may be less of a feature if AI is taking over some of those tertiary jobs. Okay, well, I don't see any questions in the queue. Thank you so much for joining us today. Look forward to speaking to you again sometime soon, and have a great rest of your summer. Take care.